Hello everyone and welcome back to the Investor's Brief. Today we're diving deep into a topic that's absolutely essential for any serious investor: fundamental analysis. If you've ever wondered how the pros decide which stocks to buy and hold for the long run, this is the video for you. So, grab a notebook and let's get started. So, what exactly is fundamental analysis? In simple terms, it's the art and science of figuring out a company's true intrinsic value. Think of it like being a detective for your investments. You're not just looking at the stock's current price, you're digging into the business itself to understand what it's really worth. This involves studying everything that can affect a company's value, from its financial health to the industry it operates in, and even the broader economy. The core idea is to compare this fair market value you've calculated with the asset's current price on the stock market. If the stock is trading for less than what you believe it's worth, it could be a fantastic buying opportunity. If it's trading for more, it might be overvalued, and you'd want to be cautious. But it's not just about one company. Fundamental analysis also looks at the big picture, what we call macroeconomic factors. Things like inflation rates, unemployment numbers, interest rate changes, and overall economic growth can have a huge impact on a company's performance and, consequently, its stock price. So, a good fundamental analyst is part economist, part business analyst, and part financial detective. Now, you might be asking, why is this so important? Can't I just follow the latest hot stock tip? Well, you could. But that's more like gambling than investing. Let's break down why fundamental analysis is so crucial. First and foremost, it helps you determine a stock's fair value. By looking at a company's earnings, its revenue streams, the assets it owns, and the liabilities it owes, you can make an educated guess about whether a stock is a good deal at its current price. It's the difference between buying a high-quality product on sale versus overpaying for something just because it's popular. Second, it helps you identify strong, long-term investment opportunities. The market can be incredibly volatile in the short term, driven by news, hype, and emotion. Fundamental analysis helps you cut through that noise. Instead of chasing fleeting trends, you're looking for healthy, well-managed companies with solid potential for growth over many years. These are the kinds of investments that can truly build wealth over time. Third, it's a powerful tool for portfolio diversification. When you understand the fundamentals of different companies and sectors, like technology, healthcare, energy, or consumer goods, you can build a balanced portfolio. You can compare their strengths, weaknesses, and growth prospects to spread your risk and optimize your potential returns. You're not just putting all your eggs in one basket, you're carefully selecting multiple strong baskets. Another huge benefit is that it encourages rational, data-driven decision-making. We're all human, and it's easy to get swept up in fear when the market drops or greed when it's soaring. Fundamental analysis acts as your anchor. When you've done your homework and you know why you invested in a company, you're far less likely to panic sell during a downturn or chase an overhyped stock at its peak. Your decisions are based on facts and analysis, not on emotional reactions. Finally, fundamental analysis is the foundation for a true long-term strategy. This is the approach used by some of the most successful investors in history, and it's the primary method for most large institutional investors like pension funds and mutual funds. Why? Because they're not just speculating, they're investing in the quality and future of a business. Without this kind of analysis, investing can quickly become a guessing game. Now let's get a bit more specific. Fundamental analysis can be broken down into two main categories: quantitative and qualitative. Quantitative analysis is all about the numbers. It's the hard data you can find in a company's financial reports. We're talking about the balance sheet, the income statement, and the cash flow statement. This is where you can see, in black and white, how a company has performed over time. You can analyze trends in its revenue, track its profitability, and see how it manages its cash. While this data is incredibly useful because it's objective and measurable, it's important to remember that these reports are lagging indicators. They tell you what has already happened, not necessarily what will happen in the future. On the other side, we have qualitative analysis. This is more subjective and looks at the factors you can't easily put a number on. Think about the quality of a company's management team. Do they have a strong track record and a clear vision for the future? What about the company's brand recognition and reputation? A powerful brand can be a massive competitive advantage. Other qualitative factors include patents, proprietary technology, and the company's overall business model. These elements are crucial for understanding a company's long-term competitive edge, its moat, so to speak. A truly great analysis combines both. The numbers tell you the story of what has happened, and the qualitative factors give you clues about what might happen next. So, let's put on our quantitative hats and talk about financial ratios. These are powerful tools that help us make sense of all the numbers in those financial statements. We can group them into several categories. First up, profitability ratios. These tell you how good a company is at turning its revenue into actual profit. The gross profit margin, for example, shows how much profit is left after paying for the cost of goods sold. The operating profit margin goes a step further, and the net profit margin tells you the final profit after all expenses, including taxes, are paid. Then you have return on assets, ROA, and return on equity, ROE, which measure how efficiently the company is using its assets and its shareholders' money to generate profits. Generally, higher margins and returns are signs of a more profitable and efficient business. Next, we have liquidity ratios. These measure a company's ability to pay its short-term bills. The current ratio, for instance, compares current assets to current liabilities. A ratio greater than 1 suggests the company has enough liquid assets to cover its obligations over the next year. This is a key indicator of short-term financial health. Then there are solvency ratios. While liquidity is about the short term, solvency is about long-term survival. These ratios, like the debt-to-equity and debt-to-assets ratios, measure a company's ability to meet its long-term debt obligations. A company with a huge amount of debt relative to its equity or assets could be in a risky position, especially if interest rates rise or its business slows down. Lower debt ratios generally indicate a more financially stable company. After that, we have efficiency ratios. These are also known as turnover ratios, and they measure how effectively a company is using its assets to generate sales. For example, the asset turnover ratio shows how much revenue a company generates for every dollar of assets it holds. A higher turnover ratio suggests the company is using its assets more efficiently. You can also look at things like inventory turnover to see how quickly a company is selling its products. Finally, we get to the valuation ratios. This is where we connect the company's internal numbers back to its stock price in the market. The most famous one is the price to earnings, or PE ratio. It compares the company's stock price to its earnings per share. A lower PE ratio might suggest a stock is undervalued, while a very high PE could mean it's overvalued or that investors expect very high growth in the future. Other popular valuation ratios include the price-to-book ratio, which compares the stock price to the company's net asset value, and the price-to-sales ratio. The dividend yield is also important for income-focused investors, as it shows how much a company pays out in dividends relative to its stock price. Phew, that was a lot of information, I know. But don't feel overwhelmed. You don't need to be a math genius to use these ratios. The key is to understand what each one tells you and to use them to compare a company to its own history and to its competitors in the same industry. Fundamental analysis is a journey, not a destination. It's a skill that you build over time through practice and continuous learning. By grounding your investment decisions in solid research and a deep understanding of the businesses you're investing in, you move away from speculation and toward a disciplined, long-term strategy for building wealth. You learn to think like a business owner, not just a stock trader. The behind the numbers, that's where qualitative analysis comes in, and it's often the key to spotting incredible investment opportunities before everyone else does. So, What exactly is qualitative fundamental analysis? Simply put, it's using your judgment and subjective analysis to decide if a stock is a good buy. For example, you might notice a coffee shop on your street is suddenly packed every morning. Or maybe you hear buzz about a company's revolutionary new product that could change the game. These are qualitative signals. They are the whispers of change that, if you listen closely, can lead to big returns. The real magic happens when you spot these changes before they show up in the company's financial statements. So, what are the key things you should be looking for? Let's break down the core elements of qualitative analysis. First up is the business model. You have to ask, what does this company actually do to make money? It sounds simple, but it's not always obvious. Take a fast food giant, for instance. Are they really just selling chicken and burgers? Or is their real moneymaker in franchising fees and real estate? Understanding the core revenue stream is fundamental. If you can't explain how a company makes money in a simple sentence, you might want to dig deeper or steer clear. A clear, sustainable business model is the bedrock of a good investment. Next, and this is a big one, is competitive advantage. Warren Buffett famously calls this a company's moat. A moat is that special something that protects a company from its competitors. Think about Coca-Cola. Their brand name is so powerful that it's a massive moat. No matter how many other colas come out, Coke remains dominant. Or consider Microsoft. For decades, its Windows operating system has dominated personal computers, creating a huge barrier to entry for any competitor. A company with a wide, durable moat can fend off rivals and generate profits for years, even decades. When you're analyzing a company, ask yourself, what stops another company from coming in and doing the exact same thing, but cheaper? If you can't find a good answer, the company's long-term success might be at risk. Another critical factor is the management team. You could have the best business model and the widest moat in the world, but with poor leadership, the company is likely to sink. The managers are the captains of the ship. It's their job to navigate challenges and execute the company's strategy. Now, as a retail investor, you probably won't get to sit down for coffee with the CEO, but you can still do your homework. Go to the company's website, look at the biographies of the top executives and board members. What's their track record? Have they been successful in previous roles? Another telling sign is insider activity. Are the top execs selling off large chunks of their stock? That could be a red flag. On the other hand, if they're buying more shares with their own money, it shows they have confidence in the company's future. Closely related to management is corporate governance. This refers to the rules and practices that determine how a company is run. You want to invest in a company that is managed ethically, transparently, and with the shareholders' best interests at heart. Are their financial reports clear and easy to understand? Do they communicate openly about the challenges they face? If a company's reports are confusing, or if they seem to be hiding bad news, that's a major warning sign. Good governance builds trust, and trust is essential for a long-term investment relationship. Always remember, you are a part owner of the business, and you deserve to be treated with respect. Now, let's zoom out a bit and look at the industry. No company exists in a vacuum. It operates within a specific industry, and the trends within that industry can have a huge impact on its success. Is the industry growing or is it shrinking? Who are the major players, and what is the competitive landscape like? Are there heavy regulations that could stifle innovation or profitability? For example, a company in a booming industry like renewable energy might have a natural tailwind pushing it forward. Conversely, a company in a declining industry, like print newspapers, will face a constant uphill battle. Understanding the industry context gives you a much clearer picture of a company's potential. Next up is stakeholder satisfaction. This is a bit more abstract, but incredibly important. Stakeholders aren't just the investors. They're the employees, the customers, the suppliers, and the community. How does the company treat its employees? Are they happy and motivated? Happy employees often lead to better customer service and innovation. What about the customers? Do they love the company's products? A loyal customer base is a powerful asset. If a company has a bad reputation with its employees or customers, its brand image will suffer, which can eventually hit the bottom line through lower sales and profits. A company that takes care of all its stakeholders is often a company that's built to last. So now that we have these qualitative insights, how do we fit them into a larger analysis framework? According to many experts, a good fundamental analysis process has four main stages. It starts with macroeconomic analysis. This is the 30,000-foot view. You look at the big picture: inflation, interest rates, economic growth, and government policies. For instance, rising interest rates can put pressure on real estate and banking stocks. Understanding these macro trends helps you see which way the economic winds are blowing. The second stage is industry analysis, which we've already touched on. After looking at the broad economy, you narrow your focus to specific sectors. Are commodity prices rising? That could be good for mining and energy companies. Is there a new technology that's about to disrupt an entire industry? This is where you identify which industries have the most promising prospects for growth. The third stage is where we get really specific: company analysis. This is where you combine both quantitative and qualitative analysis. You'll dig into the financial statements, the balance sheet, the income statement, and the cash flow statement to check the company's financial health. But you'll also apply all the qualitative factors we've discussed: the business model, competitive advantage, management, and governance. You're essentially building a complete profile of the company, looking at both the numbers and the story behind them. Finally, the fourth stage is determining the intrinsic value. This is the holy grail of fundamental analysis. Using all the data you've gathered, you try to estimate what the company is truly worth, independent of its current stock price. There are various methods for this, like using the P/E ratio, price-to-book ratio, or a discounted cash flow, DCF model. The goal is to come up with a fair value for the stock. If the current market price is significantly below your estimated intrinsic value, you've found a potentially undervalued stock, a potential buy. If it's much higher, the stock might be overvalued and risky. So, how do you put all of this into practice? It's all about turning your analysis into action. The core idea is to buy good companies at a fair price. You use your analysis to find undervalued stocks and avoid overvalued ones. You're not just chasing hot tips or trying to time the market. You're looking for quality companies with long-term growth potential, companies with consistent profitability, strong cash flow, and a healthy balance sheet. By applying these principles, you can build a balanced, resilient portfolio that's designed for long-term success, not short-term speculation. And the best part is, most of the information you need is publicly available in annual reports, investor presentations, and financial news. So why is all this work so important? Because fundamental analysis allows you to look past the day-to-day noise of the stock market. Stock prices can be volatile in the short term, driven by emotions and speculation, but over the long run, a company's stock price will ultimately reflect its underlying performance. By focusing on the fundamentals, both quantitative and qualitative, you're investing in the business itself, not just a ticker symbol. You're making informed decisions based on value and long-term potential. This patient, disciplined approach is what separates successful investors from speculators. Qualitative analysis in particular gives you that extra edge, the ability to see the future of a business before it's reflected in the spreadsheets. So, let's dive deep into the dark side of fundamental analysis. Now, don't get me wrong. It's a powerful tool for figuring out a company's long-term potential. But if you're relying on it exclusively, you might be missing some crucial pieces of the puzzle. Let's break down why. First off, let's be real. Fundamental analysis is incredibly time-consuming. You're not just glancing at a stock chart. You're digging through mountains of financial statements, economic reports, and industry data. It takes serious dedication to collect all that information, run the numbers, and make sense of it all. For many of us with busy lives, that's a huge commitment. Another major issue is that fundamental analysis is often a lagging indicator. Think about it. You are looking at financial data that reflects a company's past performance. By the time a significant change shows up in a quarterly report, the market has likely already reacted. The stock price might have already moved, meaning you've missed the boat. It's like trying to drive forward by only looking in the rearview mirror. This reliance on historical data has another catch. While past performance can give us clues, it's never a guarantee of future results. The world is constantly changing. New technologies emerge, consumer tastes shift, and unexpected events happen. Historical data can't fully prepare you for what's around the corner, and it might not capture future risks or groundbreaking opportunities. We also have to talk about accounting. The numbers you analyze are only as good as the accounting practices behind them. Companies have a lot of leeway in how they report things. Management estimates, depreciation methods, and other creative but legal accounting choices can paint a picture that isn't entirely accurate, potentially skewing your analysis. Then there are the intangibles. How do you put a price tag on a company's brand reputation, its patents, or the genius of its leadership? Think about Apple under Steve Jobs. A huge part of its value was tied to his vision, something you'd never find on a balance sheet. In today's economy, these intangible assets are more important than ever, but fundamental analysis struggles to value them. Finally, this method is built on assumptions about the economy, things like interest rates, inflation, and growth. But who has a crystal ball? Economic forecasts are notoriously tricky, and if those assumptions are wrong, your entire valuation could be off. Because it's so focused on the long-term, fundamental analysis can cause you to overlook fantastic short-term opportunities. While you're waiting for a company's intrinsic value to be realized over years, you might miss quick gains identified by things like price patterns or momentum shifts. So, what's the takeaway? Fundamental analysis is an essential tool for building conviction in your long-term investments. But it's not the only tool. Understanding its limitations helps you become a smarter, more well-rounded investor. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more insights. Thanks for watching, and I'll see you in the next video.